Investing is the best way to build long-term wealth, but most beginners sabotage themselves before they ever see results. They get caught up in hype, try to time the market, or let emotions take over, often selling at the worst possible moment. The real problem isn't complexity, it's our own psychology working against us. But once you know the common traps, you can sidestep them. Welcome to Wealthfully Yours. I'll show you the no-nonsense strategies to build wealth without stress. Today, we'll break down the top mistakes new investors make and how you can avoid them to grow your wealth safely and strategically. Let's get started. The biggest mistake: waiting for the perfect moment to invest. It sounds smart. Buy low, sell high. But that perfect moment never comes. Even Wall Street pros with supercomputers can't predict short-term market moves. While you wait, your money loses value to inflation and misses out on compounding growth. The real cost is opportunity. The solution? Dollar cost averaging. Instead of trying to time the market, invest a fixed amount on a regular schedule, no matter what the market is doing. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, this smooths out volatility and builds your position steadily. You don't have to guess when to invest. The decision is already made. This consistency is what builds real wealth. It's not glamorous, but it works. Studies show that time in the market beats timing the market. Missing just the 10 best days in the market can cut your returns in half. The best days often follow the worst, so sitting on the sidelines means missing the rebound. Set up automatic transfers to your brokerage account every month or payday. Invest in your chosen funds, then get back to living your life. The most effective strategies are the ones you can set and forget. Dollar cost averaging is simple, boring, and incredibly effective. When someone says they're waiting for the next crash, remember, that's the oldest trap in the book. Your strategy? Start today, invest consistently, and let time do the heavy lifting. The best time to start was yesterday, the second best is now. This mindset shift, from market timer to consistent investor, can make all the difference. It's the foundation of all good investing habits. So automate your investments and ignore the noise. Your future self will thank you. The next big mistake: chasing the hype. You hear about a hot stock or crypto everywhere. Social media, friends, headlines. FOMO kicks in, and you want in before it's too late. But by the time you hear about it, the smart money has already cashed out. You're buying at the peak, right before the fall. This is how bubbles form and burst. The solution? Build a solid foundation first. Before picking individual stocks or chasing trends, anchor your portfolio with broad market index funds or ETFs. An S&P 500 index fund gives you instant diversification across hundreds of companies. Legendary investors like Warren Buffett recommend this approach for most people. You're betting on the long-term growth of the economy, not a single company. Once your core is in place, say 80 to 90% of your portfolio, then, if you want, allocate a small amount to speculative plays. Think of it as play money, an amount you can afford to lose. This protects your financial future from hype-driven crashes. Ignore the noise and focus on what works. Diversified low-cost index funds. Your goal isn't to hit a home run, it's to get on base consistently. Build your foundation first. Only then, if you must, take small calculated risks. Never mistake hype for a solid strategy. One of the sneakiest wealth killers? High fees. A 1% annual fee sounds small, but it compounds year after year, eating away at your returns. Let's do the math. Invest $10,000, add $500/month for 30 years at 8% returns. In a low-cost fund, 0.04% fee, you end up with about $733,000. In a fund with a 1% fee, only $576,000, a $157,000 difference. That's money lost to fees, not market performance. Most high-fee funds don't even beat the market. The rise of low-cost index funds and ETFs from Vanguard, Schwab and Fidelity means you don't have to pay high fees for basic investing. Index funds are passively managed, so costs are low and savings go to you. Always check the expense ratio before investing. A low fee is one of the best predictors of higher net returns. You can't control the market, but you can control what you pay in fees. Audit your investments. If you're paying more than 0.5% for a broad market fund, look for lower cost options. Make it a rule, only invest in low-cost funds. Every dollar you save in fees is a dollar that compounds for you, not Wall Street. Be vigilant. Over a lifetime, this can mean 6 figures more in your pocket. Pay attention to fees. It's one of the most profitable things you can do. Another critical mistake? Putting all your eggs in one basket. Maybe it's your company stock or a tech giant you love. But betting everything on one company is risky. Even the biggest companies can fail. Think Enron, Lehman Brothers, Blockbuster. Diversification protects you from the unknown. Spread your investments across many assets so no single failure can sink your portfolio. True diversification means more than just a few stocks. Diversify across companies, industries, and sectors. For example, owning Apple, Google, and Microsoft is still tech-heavy. A broad market index fund gives you exposure to hundreds of companies in all sectors. Diversify geographically too. The US market is strong, but international funds give you access to global growth. Diversify across asset classes, stocks, bonds, and real estate. Bonds can cushion your portfolio when stocks fall. Real estate investment trusts, REITs, offer exposure to property markets without being a landlord. The goal: no single part of your portfolio should have the power to ruin you. For beginners, a simple 3-fund portfolio, US stocks, international stocks, and bonds, gives you instant broad diversification. Don't chase the perfect stock. Prepare for the future with systematic diversification. It's your best defense against the unexpected. The most dangerous mistake? Emotional investing. Fear and greed are the twin forces that wreck portfolios. Greed makes you chase hot markets and abandon your plan. Fear makes you panic sell during downturns, locking in losses. This cycle, buying high, selling low, is a recipe for disaster. The solution: replace feelings with systems. Create a simple written investment plan outlining your goals, time horizon, asset allocation, and what you'll do during a downturn. For example, during a crash I won't sell, I'll stick to my plan. Review your plan regularly. When markets get rough, follow your plan, not your emotions. Control your information diet. Stop checking your portfolio daily. It only fuels anxiety. Instead, review your investments quarterly or twice a year. Enough to rebalance, not enough to panic. The less you tinker, the better. Let your plan and automated contributions do the work. Automate your investments with dollar cost averaging to take emotion out of the equation. Markets and emotions will always fluctuate. Your plan is your anchor. Successful investing is about what you don't do. Don't panic. Don't chase, don't deviate. Build a system that protects you from yourself. Those are the 5 biggest mistakes new investors make and how to avoid them. The biggest pitfalls are psychological, not mathematical. The fix: have a plan, build slowly, stay consistent, automate your investments, focus on low-cost diversified funds, and stick to your written plan. That's how you build a portfolio that weathers storms and grows steadily. Thanks for joining me on Wealthfully Yours. Like, subscribe, and grab your free beginner's investing toolkit below. Next up, how to build a portfolio that pays you forever. Invest wisely, live freely,